You will be shocked to know that one hotel meeting crowned the dollar for 80-plus years. Here's how the rules were written and why they are fraying. Inside the New Hampshire deal that made the US dollar the world's reserve currency, hardwired fixed exchange rates, and set the stage for the world we live in today. Quick check-in before we roll. Where are you watching from? Drop your city below. And hit subscribe if you want the unfiltered, easy-to-follow breakdowns no textbook gives you. All supporting links are present in description. You can check out to know more. All right, let's step into the Mount Washington Hotel, the hotel where money's new rules were written. It's July 1944. World War II isn't even over yet, but 730 delegates from 44 Allied nations squeeze into a grand hotel in Bretton Woods, New Hampshire. The mission: stop the next Great Depression before it starts, rebuild trade, and keep currencies from crashing into each other like race cars on ice. Two stars walk into that room with competing blueprints. John Maynard Keynes from Britain wants a new global money, the Bancor, run by a powerful clearing union. Less pressure on any single country, more balance. Harry Dexter White from the US Treasury wants a system centered on the dollar because the US holds most of the world's gold and half its industrial power. Guess whose plan won? The country with the gold, guns, and factories. By the end, the delegates sign a deal that hardwires three big features into the global system. 1. Fixed but adjustable exchange rates. Each country pegs its currency to the dollar. The dollar pegs to gold at $35 per ounce. Currencies can wiggle within 1%, but major changes require a formal adjustment. 2. Gold convertibility, just for governments. Foreign central banks can trade dollars for US gold at 35 Oz. You and I can't. This is a nation-to-nation anchor. 3. Capital controls. Countries can restrict fast money sloshing across borders so they can run their own interest rates and jobs policies without being whipsawed by speculators. They also create two new institutions. The IMF, a crisis firefighter and rule umpire. Members pay a quota based on their economic size. That quota decides how much they can borrow and how many votes they get. The US gets a massive share and, critically, an effective veto on big decisions. Major changes require 85% approval. The US sits above that blocking stake. The World Bank, IBRD, to fund rebuilding and development. Why did the world go along? By 1944, the US held roughly 2/3 of the planet's official gold. If you wanted stability, you needed the one country that was solvent, industrial, and intact. That anchor, $35 per ounce, felt like a rock. Sound simple? It was elegant. And it worked. For a while. How Bretton Woods worked in real life. Picture a world financial thermostat set to stable. Your currency is pegged to the dollar. If it drifts too far, your central bank buys or sells currency to push it back. The IMF stands ready with short-term loans if you hit a rough patch in trade. Because capital controls are allowed, hot money can't blast across borders and blow up your domestic policy. From 1945 through the late 1950s, this system powers a boom. Europe rebuilds. Germany and Japan export like crazy. Trade grows. Factories hum. Living standards rise. The dollar becomes the invoice for ships, steel, and sugar. Under the hood, the US runs trade surpluses and sends dollars overseas via the Marshall Plan, military spending, and private investment. Those dollars are the grease in the machine. Enough liquidity for the world to trade, rebuild, and save. So, where's the catch? It sneaks in through the system's very design. The hidden flaw, Triffin's dilemma. In 1960, an economist named Robert Triffin drops a bombshell. For the world to have enough dollars to grow, the US must send dollars out by running deficits. But the more dollars the US sends out, the less gold it has to back them at 35 Oz. Eventually, foreign central banks will ask for gold, and the US won't have enough to satisfy everyone at the promised price. Confidence cracks, or the US has to slam on the brakes and choke the world of dollars. That's the Triffin dilemma, built into the system's DNA. At the same time, another force is rising, the euro-dollar market. Starting in the late 1950s, banks in London and elsewhere begin taking dollar deposits and making dollar loans outside US regulation. Offshore dollars multiply. Capital controls become porous. It's like building a dam and then discovering a river running under it. Sound familiar? The cracks spread, sterling, gold, and war. By the mid-1960s, the pressure is visible. 1961, major central banks secretly formed the London Gold Pool to keep gold at 35 Oz by quietly selling into the market. It works until it doesn't. 1967, the British pound devalues by about 14%. Confidence wobbles. 1968, a full-blown run on gold. The gold pool breaks. Officials create a two-tier market. One price for central banks at $35, another for everyone else in the open market. We'll pretend the official price still holds while the real world trades higher. That illusion buys time. At home, America runs guns and butter, Vietnam War plus Great Society programs without raising enough taxes. Inflation ticks up. Dollars pour overseas. France's Charles de Gaulle famously sends dollars to New York and asks for gold. Others line up. U.S. gold reserves keep dropping, from over 20,000 metric tons after the war to about 8,133 tons in the early 1970s. At the official $35 price, that's not enough to meet growing claims. The math is turning against the promise. The day the music stopped. August 15, 1971, President Richard Nixon interrupts Sunday night TV. He announces wage and price controls, a 10% import surcharge, and the big one, the U.S. is suspending the dollar's convertibility into gold. The promise of $35 is gone. Nixon frames it as a temporary move. Spoiler: temporary becomes forever. In December 1971, the Smithsonian Agreement tries to patch things up by adjusting currencies and moving gold to 38 Oz on paper. Markets aren't buying it. By 1973, the system snaps. Major currencies float. The dollar is still central, but now it's backed by the size of the U.S. economy, deep financial markets, and trust, not a gold peg. The Bretton Woods era ends. The dollar era doesn't. Why the dollar still won after gold? This is the twist people miss. Bretton Woods hardwired dollar habits into the world. Trade, banking, reserves, legal contracts. Those habits didn't vanish in 1971. They adapted. Oil and commodities kept being priced in dollars, and after 1974, the U.S.-Saudi understanding cemented that for oil. The euro-dollar market exploded. Banks outside the U.S. created and lent dollar credit globally. The IMF and World Bank kept operating as crisis managers, mostly in a dollar world. U.S. financial markets became the deepest, most liquid place to park savings, especially in U.S. treasuries. Result: even without gold, the dollar remained the operating system of global trade and finance. Let's bring this home with plain English takeaways. Fixed exchange rates tied to the dollar created stability after a war-ravaged era. That ruled for about 25 years. The promise of $35 gold convertibility gave confidence, but planted a time bomb, Triffin's dilemma. Capital controls kept the system from being blown up by hot money until the euro-dollar market tunneled around them. When the pressure got too high, the U.S. chose growth and flexibility over the gold promise. The peg died. The dollar lived. What this means for you, then and now. If you were alive in the 1950s and early 1960s, your currency was steady. Vacations abroad were predictable. Big devaluations were rare and managed. The price you paid was less freedom to move money quickly, but more stability at home. If you live now, you're in a world with floating rates and instant capital flows. Your mortgage rate, your rent, even your grocery bill can move with global shocks, because the dollar still sits at the center, and when the dollar jumps, it pulls prices and policy with it. Today's signals that the old rules are fraying. Sanctions and reserve freezes, like the roughly $300 billion of Russian central bank assets frozen in 2022, show money is now openly used as leverage. That's power, but it also makes other countries think hard about Plan B. Central banks are buying gold at the fastest pace in decades. Why? Not to go back to 1944, but to diversify their rainy day funds away from pure dollars and euros. Countries are experimenting with local currency trade, digital currencies, and alternative payment rails. The euro and yuan have bigger roles than in 1971, though still far from the dollar's reach. Sound familiar? Why Bretton Woods was built, why it broke. Problem after 1930s: currency chaos, trade collapse, destructive devaluations. Solution in 1944: fixed exchange rates around the dollar, gold convertibility for central banks, IMF as referee, capital controls to prevent hot money fires. Why it worked. The US had the gold, the factories, and the will. The rules gave predictability while economies rebuilt. Why it cracked. The system needed more and more dollars to function, but more dollars meant less gold backing. Add war spending, inflation, and offshore eurodollars, and the promise became impossible to keep. What replaced it? Floating currencies, bigger financial markets, and an even larger global role for the dollar, now backed by network effects and deep markets instead of metal. The dollar's next chapter: de-globalizing world. Are we heading toward Bretton Woods 2.0? Don't expect a single hotel to reset the world again, but watch these pressure points. Fragmented trade. Friendshoring, regional supply chains, and geopolitical blocks mean fewer shared rules. Energy transitions. As oil's role slowly shifts, the oil-dollar link could morph, but not vanish overnight. Financial plumbing. The Federal Reserve AS swap lines and the FIMA repo facility, created in 2020, show how crises are now handled, by piping dollars directly to allied central banks. That's a new kind of convertibility, not into gold, but into liquidity when it counts. Competing rails. Europe's euro, China's CIPS, and central bank digital currencies are building options. Options aren't the same as replacements, but they matter. The honest bottom line: the dollar still dominates, about 58% of global reserves, approx, 88% of FX trades, and more than 60% of international debt. But the world is clearly testing how to need the dollar less. That's the fraying you feel in headlines. The story in 3 sentences. One hotel meeting set the rules. Peg to the dollar, peg the dollar to gold, let the IMF manage the bumps. The rules worked, until the math and the politics didn't. The peg died in 1971-73. The habits survived. The dollar kept the crown, not by gold, but by being the network everyone was already wired into. Central bank gold purchases, a barometer of diversification. The share of global reserves held in dollars versus euro-yuan. Big oil and commodity contracts. Do they keep using dollars? The Fed's swap line activity during crises. Are the hoses opening more often? Major sanctions decisions, and how non-aligned countries react. If this brought the story to life for you, share it with a friend who has heard Bretton Woods, but never really knew what it meant. And tell me in the comments where you're watching from, and which part shocked you most. Hit subscribe for more clear, human explainers on the money system. Also, are you curious to know how the US dollar became the world's reserve currency and why it still rules? Check out this video.